Hi, welcome to the Market Alert for Monday, 25th of March 2019. There's a lot going on at the moment, so I'm going to try and whiz through it, but also bring the detail to your attention as well. The pound for Friday, this was higher, hitting resistance here. We've still got that lower high situation there in place. And overnight, we're seeing prices also sideways to lower, and that is based upon speculation that we're seeing here that the PM fights to retain power as MPs look to seize control of Brexit. So we're now taking another turn where we could end up with seeing a new leader before long. Farce isn't in it really. What an absolute unmitigated disaster. So the pound showing a bit of weakness because of this, but Friday we can see that the market was already below the 200 bar moving average. It attempted to move lower here, came back and then put in another sell signal and moved lower, and then good news came out and moved the price back to the upside. But overnight prices are moving lower, and we can see this here. We're not below the 200 bar moving average yet, or the DP. We've just traded down to this. But it depends, of course, what happens today. If May throws in the towel or she's pushed off the cliff, who knows? All very interesting to say the least. You'd expect a bit more volatility, to be honest with you, in the pound, given the background with Brexit and this obviously now potential coup. Amazing how quiet it is. So it just goes to show, no doubts that the Bank of England have got a hand in keeping the pound steady at the moment. Using taxpayers' money is the only thing that I can see. No news today as far as the markets are concerned, economic news, but that doesn't mean to say that we won't get some movement, especially if May does throw in the towel, which I very much doubt. She's hanging in there and is not going to let it go unless she's shoved. Meanwhile, in the Dow Friday, I spoke about this and said that we were up on Thursday following Wednesday's FOMC meeting, and then the selling came in on Friday. A lot of volume here as well. You can see a big spike in volume. Now, I'm going to bore you for a few minutes. With regards to this, we can also see that the market is down on the overnight as well. But what's fascinating is this. You'll see here we've got the headlines over the last 2 to 3 days about the yield curve. And we've looked at this many times. We also looked at it last week about the inversion of the yield curve. There's a brilliant article on Zero Hedge, Bloomberg, FT, all of them pointing towards what this really means. So let's have a look through this, because this is very important. Yield curve inverts for the first time since 2007. Recession countdown begins. So what they're saying here is that the spread, that's the difference between the 3-month and 10-year yield, once this inverts, it's a trigger for a recession. Well, the question is how good of a predictor is this for a recession, or predicting one? So let's have a look at this bit here. It says, as below, on 6 occasions over the last 50 years, when the 3-month yield exceeded that of the 10-year, economic recession invariably followed, commencing an average of 311 days after the initial signal. And here is Bloomberg showing how the yield curve inverted between 89, 2000, 2006, with recessions prompting starting 90, 201 and 208. This time won't be different. Blimey, it's going to be even worse given the situation of printing all of the money, which has made no difference whatsoever except create asset bubbles. So here you can see where it inverted in 90, 2000, 2006, with the recessions following subsequently, and an average of 300 days. So we're looking around the late summer and early autumn there. Also, equity markets appear to be waking up, and again, that just goes back to what I was talking about here, that we are starting to see the selling It looks like at the moment it's definitely over as far as the upside for this market is concerned. Again, something I warned of last week, even though the market moved up on Thursday, that we would start to see the stock market struggle. So yeah, on the heels of German PMI print, world bond yields have tumbled, extending US Treasuries rate collapse since the Fed flip-flopped full dovetailed, which was last week, when they went from being hawkish to dovish. And there you can see when the German PMI came out. So again, if Germany, the strongest economy in Europe, is struggling, then it's not going to be much fun for the rest of them. And here you can see the yield curve has now inverted through the 7-year. You can see that the spread through the 7-year has also gone negative, and bonds and stocks bid after Powell threw in the towel. So the stock market moved higher and the yields moved lower. However, as I've said before, until he starts to reduce rates, which is probably likely to be later on in this year, then you will see the stock market pick up a bit. But until then, it's under some serious pressure to try and move higher at this time. Also here it says crushing the spread between 3 and 10-month Treasury rates to just 2.4 basis points, a smidge away from flashing a big red recession warning. So another interesting chart here. You can see once we got below the 2.4 area on the spread, then this triggered recessions before. And it's not new to the market alert. So equity markets remain ignorant of the risk and seemingly banking it all on the Powell put. And what they mean by the Powell put is that he's going to come to the rescue. And we give the last words to Double Line's Jeff Gunlack, a word of caution on the massive decoupling between bonds and stocks. And as he says here, and I couldn't agree more, just because things seem invincible doesn't mean they are invincible. There is kryptonite everywhere. Yesterday's move created more uncertainty. And that's what we're seeing here now in the Dow, with prices heading down towards the 200 bar moving average. This is going to be crucial. Prices will need to stay above this. But we'll keep an eye on the yields over the next few days just to see if that 2.4 is broken in the 3-month and 10-month spread. So Friday intraday, the market was already struggling. It was below the 200 bar moving average. It attempted to move higher, was then hit with selling. We've got a bit of a bounce back here, but you can see how the market stayed below the 20 bar moving average until late on. We then had the classic retracement there, and we had a bit of a bounce from the plunge protection team at the end of the session, which then soon petered out as well. Overnight, the market gapped higher. We've had the Mueller report as well, which found there was no conspiracy with Russia. What a surprise. Waste of $40 million. And now we see the Dow finding a bit of support at the moment, but still making those lows. Bit of profit taking going on at the moment from the shorts on the overnight market there. And then finally, in Bitcoin, nothing to report. Not going to stay here looking at it. You can see over the last few days, the market has remained sideways. Okay, that will do for this one. We're certainly starting to see some very interesting things take place. Keep an eye on the Dow in the pre-market session. Also, expect a bounce. It isn't just going to fall out of bed. And as the data shows, over 50 years, it can be up to 300 days away. It's just a matter of being forewarned is forearmed. So there will be ups and downs in the stock market before we get anything major. But certainly until either interest rates are reduced and the potential of printing more money, then the stock market is certainly going to be under pressure, just like Mrs. May is at the moment. Okay, that will do it for this one. If there is anything to report, I will let you know. But otherwise, as ever, thanks for watching. See you in the next one.